Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I am pleased to welcome my guest, Kristina Hooper, Chief Global Market Strategist at Invesco. Kristina, welcome to the program.
Thank you so much for having me, Marianne.
What a time to have you here. There's so much going on, not only in the United States, but around the world. But I want to start here at home, and we are now filming kind of towards the middle of March. I want to say this because events are changing, and this podcast may not come out for a couple of weeks. So we're kind of around March 18th while we're talking. A lot of events have happened in, I think, less than 60 days of Trump 2.0. We've got talks of tariffs. We have talks of Doge and layoffs. And this has unsettled the equity markets because this is not what the equity markets expected. Right now, the S&P is down from peak to trough 10%. And it's one of the fastest declines in history. And this is really unnerving clients. And I can't blame them. So when clients start talking or calling in and asking you, what do we do? What's happening? What are some of the words of wisdom that you're giving your client base?
Well, first of all, Marianne, I think that it's important to recognize that we are seeing something of a tectonic shift going on when it comes to a fiscal impulse. We're seeing significant cuts occurring in government spending in the U.S. If Doge achieves what it is setting out to do, that means that you are going to have a scenario where government spending goes down very dramatically, and there's a multiplier effect. It ripples through the economy, and you have tariffs on top of that. So there are a lot of economic headwinds facing the U.S. economy and, of course, markets, which I think is what is reflected in this meteoric and quite rapid drop in the stock market. But I think this is a very valuable lesson in the importance of diversification, because at the same time we're seeing this real shift in the US, we're also seeing a shift in Europe. We're finally seeing Europe opening up the purse strings, including Germany, and saying, we need to increase defense spending. And by the way, we'll also increase spending in areas like infrastructure. So the fiscal impulse has gotten very strong in Europe is getting very strong in a pretty short period of time.
Which is not what they normally do. This is big for them.
No, this is huge because Germany actually has been so laser focused on fiscal prudence that it's done that to the detriment of its own economy, especially manufacturing, I would argue, in recent years. So what we're seeing now is an opening of the purse strings in areas that are likely to benefit those that have been the weakest, like German manufacturing. So I think this is a very exciting time for Europe. Now, keep in mind, when we were going into this year, there was a real case for why European markets were attractive. You had very low valuations. You had the high dividend yields. You even had high buyback yields, which is a change from the past. So this was a time when European markets already looked attractive, but we know that value can stay value for a long time. The catalyst is this getting their act together. We've got less political uncertainty than we had going into the year. The German elections, I think, are really important in terms of improving consumer sentiment, investor sentiment. And now we've got this increase in spending. So I think there is a lot going on that's positive. And as a result, we've seen this nice rise in European markets. But that's not the only place of opportunity. There are a lot of areas of opportunity around the world in a variety of different asset classes, including, of course, gold.
I like gold, by the way.
I can tell.
Yeah, I would agree with you. It's a little extended here, so it could have some volatility, but gold does look to have a long-term uptrend, and central banks are very big buyers, particularly the Chinese, is my understanding.
Absolutely, and it makes sense. I think some of this is a reaction to financial sanctions in the wake of Russia's invasion of Ukraine. But the reality is that gold is increasingly being used as a geopolitical risk hedge. And in a time when there's an awful lot of geopolitical risk, it seems to be reasonable and rational to see investors piling into gold. And of course, we do have central banks that are not very price sensitive, also, of course, piling into gold.
So let's come back home a little bit.
Mm-hmm.
Earlier this year, we were concerned about inflation. And all of a sudden, we've gone from all of these fears of inflation and strong economic growth to possibly having a recession. Now, economies don't move that fast. So can you kind of give us some perspective of where you see the U.S. economy, at least at this time? Obviously, things can change based on what happens with tariffs, but what's your outlook so far for the U.S.?
So, Marianne, I think of it this way. If we go back to 2009, I spent an inordinate amount of time looking for green shoots in the spring and summer of 2009. We were in the midst of a deep, deep recession, and we were looking for signs that policies were working and that the economy was starting to rebuild and grow. And now I'm looking, not desperately, in fact, very reluctantly, for brown shoots. Signs that the U.S. economy is wilting. And that's because we have seen this very significant shift in the U.S. economy. We're less worried about inflation, so that's a good thing. And of course, we got a nice CPI print last week that makes me a little bit more comfortable about the threat of a resurgence in inflation. But at the same time, we have tariffs, which we know in 2018 caused problems for the economy. They were very short-lived, but we saw prices go up. We saw a chilling effect on investment, business investment. We saw a somewhat chilling effect on hiring, but the economy bounced back rather quickly. So I think the real issue now is it's not just the tariffs, and they're being fought in a variety of different fronts at the same time. It's not just U.S., China, tit-for-tat tariffs. Now it's a number of different countries involved. But I think the much bigger issue is DOGE and the kinds of cuts in government spending that seem to be occurring and what it might mean in terms of ripple effects through the economy. I think of it this way. There's a multiplier effect for every line item of government spending, and some multiplier effects are higher than others. For example, if you have low income tax cuts or infrastructure spending, that tends to have a higher multiplier effect, all else being equal, relative to other line items of government spending. The reality is we're seeing cuts that likely have higher multiplier effects. And so that's going to be ripples through the economy. And we're already seeing anecdotal information, like, for example, the Federal Reserve Beige Book, the Institute for Supply Management survey, the S&P Global PMI survey, all suggesting that businesses are quite concerned about a reduction in government spending and how, and because it's government spending, it's laying off employees and what that can do to the economy overall. So I think we are at a place where if we continue down this path and we have really aggressive spending cuts, we could easily get to a recession, but we're not there yet.
So this is creating a lot of uncertainty. And we're starting to see maybe the consumer slow down in terms of spending. And the consumer makes up a large portion of the growth of our economy and GDP. Where are you seeing the consumer right now?
So first I would say the consumer has been very resilient, and the consumer is in a relatively good place. If we compare this to, for example, the global financial crisis, the consumer has much less debt. And consumers, for most of them, their largest debt is a mortgage, and those tend to be relatively low rates that are locked in over a long period of time. So their household balance sheets are in better order than they have been heading into previous crises. So that's a good thing. The problem, though, is that there are a lot of households that don't have significant savings, and a firing, a job loss could put them over the edge. And that's why I think it's so important to be following metrics like the unemployment rate.
Which is 4.1 right now.
Exactly, which is great. But could we easily trigger the SOM rule if, for example, we see government layoffs that are significant? And of course, also government contractors that lose their jobs. So I think we just need to be very vigilant because the consumer is in pretty good shape, but they're certainly worried. And we're seeing it manifest in companies' reports. We just got a warning last week in a regulatory filing from Delta saying, hey, consumers, we anticipate reduced spending. We're hearing it from a variety of different companies. Macy's is saying the affluent consumer is concerned and has uncertainty about the economic outlook. And of course, we're seeing it in the University of Michigan survey of consumers. Consumer sentiment, as you mentioned, has gone down so much. So we have to be very sensitive to that. We have to be vigilant about looking for signs that there are going to be more brown shoots. That to me is my biggest fear right now.
That's where diversification comes in terms of a portfolio.
Absolutely, because there could be brown shoots in one place and green shoots in another. And I think we can't think things in terms of we can only invest in a place where the economy is very strong. It's actually important to invest in areas where we see some positive surprise or we anticipate some positive surprise. So certainly the European economy has a lot of flaws, but I think we're continuing to see upside potential.
So maybe they have some green shoots.
I would argue that that's what we're seeing right now.
Or what I like to say, because we're coming into spring, they're starting to maybe blossom a little bit.
There you go. And even better.
Let's go back to tariffs, because this is very, very topical. Do you have any sense yet if tariffs can impact corporate earnings? We're about to get first quarter earnings in a few weeks. We'll start getting our first quarter. So tariffs are not going to really impact first quarter earnings. This is probably a story for second, third, going into the end of the year. Has anybody been able to estimate where tariffs are in terms of impacting corporate earnings, or is it too soon to actually say anything yet?
That is a great question. And I think it can be a fool's errand to try to figure out how tariffs impact corporate earnings because it is so easy to put them on, take them off. And that, in fact, is what we've seen thus far, is 1 minute you have a 25% tariff on something and then it goes away 2 days later. So it's very hard to assess the impact. I think more of the impact comes from having that chilling effect because of the uncertainty, not wanting to make any kind of significant business investments or, for example, hiring. And if we go back to 2018, 2019, that's what we saw. Really didn't have any kind of significant impact on earnings, but it did have an impact on businesses and what they did, how much they invested, and how much hiring they did. So I would assume our best rule of thumb is the playbook from the first Trump administration in terms of guesstimating how tariffs impact the economy this time around.
What about the inflation concern about tariffs? Can you dive a little bit deeper into that? I have heard that you can have, and you mentioned this in 2018-19, you have this inflationary event, but then it falls off.
Yeah.
So it's not necessarily permanent.
No, it's not sustainable inflation, in my opinion. That's certainly not what we saw. Unless those tariffs stay on and never come off, which doesn't seem to be the case. It seems to be they're much more likely to be used as a negotiating tool. So that means they're probably going to be relatively brief in nature. And so from my perspective, I don't think of them as any kind of significant inflation risk because it's not sustainable price increases.
So let's take a look now at interest rates. The Fed is meeting this week, so this is going to come out after the Fed meeting. And obviously the Fed has been very concerned about the labor market and the slowdown in the labor market or potential future slowdown, but they're also concerned about inflation expectations and inflation. They've commented that inflation has come down, but it's not to their target of 2%. Do you have any gauge of where you think interest rates could possibly go over the coming months?
It's going to be very, very hard sitting in March in terms of anticipating what we're likely to see for the U.S. economy this year. I actually think it's one of the hardest jobs in the nation to be a member of the Fed right now and make that decision. But luckily, they don't have to decide in March, and it seems as though they're very, very likely to sit on their hands and wait and play that waiting game. But they do have to give us a dot plot. Which I think
Let's explain a dot plot. I remember the first time I heard dot plot, and I'm like, "What is that?" And I was in the markets for a long time.
Well,
So
we lived through Alan Greenspan judging what the Fed was going to do by the size of his briefcase. So we've come a long way since then, but now it's uber transparency, right? And so the dot plot is just each FOMC member's estimates for what they think the policy prescription should be for the year. So where they think we're going to end up with the Fed funds rate, where they think we're going to end up in terms of inflation, GDP growth, etc. And so it can be very valuable just to have a look inside their brain. It's a snapshot in time, but I do think it's helpful. And especially so right now because markets, the U.S. stock market doesn't have a lot to look forward to right now. Right? We have all these economic headwinds we've talked about, and perhaps the only, significant positive catalyst they might get this year is some Fed easing. And so all eyes, I think, will be on this dot plot and what it might say about FOMC members' inclinations in terms of offering easing this year, even though, of course, we have elevated inflation expectations, which they pay attention to.
So one of the things that we were talking about maybe a month and a half ago, 2 months ago, was productivity enhancements from innovation, artificial intelligence. Do you think that could be a potential offset? Because I've been listening to some companies and they're still going full throttle in terms of investing in artificial intelligence. Can that eventually also be an offset for the economy?
Oh, I think so. I think of this time period as very similar to the mid 1990s when we saw this ramp up in technology investment, really in reaction to the need to get on the internet, create websites, create e-commerce, and take advantage of technological innovation by investing in it. And then, of course, there was also significant technology investment around the Y2K upgrade. All of that resulted in improved productivity, and we saw a nice surge in productivity. And I think that's where we are now, is we're putting a lot of investment. Companies are investing in AI. They're saying there's a bigger risk in underinvesting than overinvesting. They're already seeing the benefits of investing in AI, and they're continuing, even though they've gotten some pushback from investors on this. So I think what we're likely to see is some really nice productivity dividends paid out. Maybe not tomorrow, but we will see them. And in fact, already companies are talking about improvements that they've seen as a result of that investment. I think that's going to continue.
Now, Invesco has the QQQ, which is the NASDAQ 100, which I have affectionately called the digital index because it houses so many innovative companies. So I just wanted to highlight, if you're looking to invest in innovation in digital, you get a concentrated, diversified group of stocks that are heavily skewed towards that innovation. Let's go back around the world. We talked about the opportunities in Europe. What about emerging markets? What about China? What are some of the other opportunities that investors should be looking at?
So let's talk a little bit about China in particular. I think what we're seeing is somewhat similar to what we're seeing in Europe, in that there is more fiscal stimulus coming. And as a result, we've already seen some pickup in, for example, auto sales in the first couple of months of this year. There's definitely an improvement in the fiscal impulse, and that's a positive for China. We think that will continue. I don't see it as being as strong right now as the excitement over Europe, because it's just such a 180 from where we were. But fiscal stimulus in China, I think, is going to be a positive for the stock market. And we've already seen the stock market react to hearing last fall about plans for significant fiscal stimulus. I think that'll continue. And interestingly, I think the threat of tariffs might actually be a catalyst for more fiscal stimulus than we would have otherwise had in China. So I think there's lots of opportunity there. We also have to recognize that, technology, advancements like DeepSeek, for example, are causing a re-rating in China tech stocks. I think there's a recognition that there's a lot of opportunity there. These are very undervalued stocks, and so I think we're going to see more investor interest there as well. Now, in terms of emerging markets, the historical take on EM is that when the Fed is easing, that creates opportunities. That tends to be a positive time for emerging markets equities. And so I think many investors, many clients are asking themselves, should I be in EM? Because the Fed seems to be sitting on its hands. We don't know how long there'll be a pause, if we'll get more easing. I think there are a lot of growth opportunities in emerging markets, regardless of what the Fed does. And I think we are going to have to be more discerning. I think this is not a time, and more selective. I think this is not a time where we assume a rising tide floats all boats in emerging markets, but I think there are opportunities in countries, in sectors, and of course, individual companies.
So there's a lot of cash on the sidelines. If we look at money market funds, there's $7 trillion sitting in cash. I always say when markets go down, they're never on good news. It's, the time to buy is when things are down, but it feels terrible. So for clients that have some cash on the sidelines, what are some of the investment opportunities that you're talking to clients about?
Well, first and foremost, it's about being well diversified. And hey, if you haven't rebalanced your portfolio in a while, you're probably overweight certain areas and underweight certain areas because of past performance over the last 5-10 years. So taking some cash off the sidelines and deploying it can, of course, alter allocations. And of course, one could also just rebalance. But I think there's an opportunity with cash sitting on the sidelines to go where the value is, go where the yields are. Dividend yields are an important consideration, especially in an environment where we do have more volatility. It offers you the opportunity to be paid to wait when you might be waiting. I mean, we just don't know how this year unfolds. So I think taking some of that cash and even dollar cost averaging in could be a prudent approach this year, especially for U.S. stocks. We don't know if they're going to go down more. We just don't know where they're going to go. But
because there's still so much uncertainty, at least at this time of this recording.
But there is, that's when there are opportunities. It's, as Warren Buffett says, when everyone else is fearful, that's the time to be greedy, and vice versa.
Are there any particular sectors or industry groups that look interesting to you?
So, when we were heading into this year, we put out our outlook back in November. We felt we would see actually a very modest slowdown in the U.S. and then a reacceleration. And that drove us towards small and mid-cap stocks and cyclicals, because those are the most sensitive to the economic cycle. So a reacceleration would benefit them. Now, of course, we're a little more cautious, and I would say the opportunities arguably lie in European cyclicals, in European mid-caps and small caps, because those are likely to be very sensitive to an economy that appears poised to reaccelerate and show strength. So I would focus on the industrials, the materials, certainly defense, in Europe, because we know that is where there's going to be significant spending going on in coming months and years.
Well, part of managing a portfolio also involves fixed income, and that involves interest rates. So when you're looking at the fixed income side of the equation, Is that a ballast to portfolios? Is that something that clients should be looking at? There was a period where people said 60-40 is dead, where you're 60% equities, 40% bonds, forget about the bonds. And then all of a sudden bonds, did very badly, and now they're doing much better. So are there any opportunities within fixed income when you're looking to diversify your portfolio?
Well, I certainly think there are opportunities for fixed income. I think it's important to be well diversified, and that includes exposure to fixed income. I'd say right now, probably some of the most attractive opportunities are in European investment grade and high yield because of expectations around the European economy. But also there are opportunities in the U.S. U.S. municipals look attractive right now. I think we have to recognize that while this might not be a golden age or a paradise of high yields, we're in a much better place in terms of yields than we've been for a number of years. And so taking advantage of that, being well diversified, having some exposure to convertible bonds, having some exposure to bank loans makes sense in this environment. But again, be well diversified and know where probably the short-term areas of opportunity are, which I would argue can be found in Europe.
So part of a portfolio, there's a section called alternatives. Gold tends to be in there. We know you like gold. But we have what seems to be this new asset class called cryptocurrencies, where Bitcoin has now entered the lingo of part of asset allocation. And Invesco, I believe, has a relationship with an ETF with Bitcoin. Do you have any views in the crypto space?
So, my view is that investors should look at what any asset class offers for a portfolio and then decide whether or not they want to include it in their portfolio. And so for cryptocurrencies, one has to ask, is it because I want a low correlating asset class? And if that's the reason why you'd want to include it in the portfolio, you just want to be careful because it's over recent years has developed a much higher or exhibited a much higher correlation with, for example, large cap tech. So we want to recognize that and know that we may not be getting a low correlating asset class.
It has a lot of volatility, and I would argue it has more volatility than the equity market in general.
It does. Now, again, that if it's not behaving or really closely correlated, that can be a positive because that provides diversification. But we have to know what we're putting in our portfolio and how it's likely to behave just based on past history.
And what our risk tolerance are.
Exactly. But I think for those who are simply interested in it because it's a speculative asset class and there can be high returns, there's the potential for high returns. I think, again, it's, what are we comfortable with in terms of an allocation given our risk tolerance? I do think, though, that right now regulatory policy is likely to be a positive for cryptocurrencies. And also, of course, you could have a tailwind of a creation of a Bitcoin reserve fund in the United States. There's certainly been a lot of momentum behind that. But again, I think this is very much each client's decision with their advisors based on their risk tolerance and why they would want to put it in their portfolio.
Well, this has been a great trip around the world for investing, and we've covered a lot of topics, but is there anything that I haven't touched upon that you think our listeners would be interested in or should know about?
So, Marian, I guess I would just say that this is, of course, we've said it many times today, a time of uncertainty. There's a lot of volatility in markets. And quite frankly, there are a lot of headlines in the news that can get clients spooked. So what I would say is that, again, based on what I've seen in my 30 or so years in the industry, the biggest mistake investors made during the global financial crisis, and I think the biggest mistake investors can make, period, is getting spooked, getting out of the markets, and locking in their losses. I think it's very important to be well diversified and then allow markets to do whatever they do without getting so spooked that one alters their investment portfolio, gets out, locks in losses, misses out on a rebound. Most clients do not have the same time horizon as a tariff war, as a presidential term. They often have much longer time horizons. So they shouldn't let all these gyrations and all these scary headlines alter their long-term goals and their plans for achieving those long-term goals.
I 100% agree with you. I've been doing this for 40 years. And for 40 years, there's always been a reason not to invest in markets. There's always something happening. And I've always told investors, patience. If you set your goals and you have patience, you review your goals, you rebalance, in the long run, things work out. And these are opportunities. When we get movements in markets, there are actually probably more opportunities than not.
Definitely. Sell-offs can certainly be opportunities, especially for all those that are sitting on their large pile of cash.
Kristina, this has just been an amazing and enlightening conversation. I cannot thank you enough for joining us here today.
I feel the same way. Thank you so much, Marianne.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.